Question number 4. In this illustration, one of the assets could have been discarded or sold, but the sale routed through a new account called machinery disposal account. Let's see. Okay, what is the requirement? Prepare machinery account, provision for depreciation account, and machinery disposal account. It was for 5 marks question. We have to prepare for only 1 year. Only 1 year. On December 2011, 2 machines which were purchased on 1st October 2008, costing 50 and 20 respectively, had to be discarded and replaced by 2 new machines costing 50 and 25. In which year? December 2011. One of the discarded machines was sold for rupees 20 and then the other for 10,000 rupees. The balance of machinery accounts as on 1st April 2011 being 3 lakhs, against which the depreciation provision stood at rupees 1,50,000. Depreciation was provided at the rate of 10% on reducing balance method, which is nothing but WDV method. Right. Let's see here. We have to prepare only for which year? This year, April 2011 to 31st March 2012 only. Machinery account. Machinery account. Okay. And then we have a provision for depreciation account. Provision for depreciation account. Okay. And then we have a machinery disposal account here. Machinery disposal account. Machinery disposal. So in this case, the asset sale, sold or disposed is routed through the machinery disposal account. Okay, you have to understand. Whenever any asset sold and it is routed through the machinery disposal account, means the value of the asset sold will be transferable from that concerned asset account debit to concerned asset to machinery disposal account, transferable from here to there. And accumulated provision should also be transferable from the provision for depreciation to machinery disposal account. So here I am transferring the provision for depreciation also here, and asset value will be transferable from here to there. If the asset sold being having a original value of 100, then it is transferable to the machinery disposal account, and depreciation on the asset sold being say 40, that should also be transferable to the asset disposal account. Then whatever the sale happens, it's routed through the machinery disposal account only. Is that okay? This is the model here. Now, I am going to prepare for only 1 year, 2011 and 12. In 11, initially we have 3 lakhs rupees as assets value, provision for depreciation being 1,50,000. 1,50,000. Let's see here. In the year beginning, 1st April 2011, balance brought down. Balance brought down 3 lakhs, and here 1/4/2011, 1/4/2011. Okay, balance brought down. The value being 1,50,000. Okay. Here, 2 machines which were purchased on 1st October costing 50 and 20 respectively had to be discarded. Had to be discarded. Then automatically any asset sold, the original value of the asset sold will be transferable from the machinery account to machinery disposal account. Right. On which date? December 2011. December 2011. I assume that sale happens exactly on the last date. 31st December 2011. Machinery disposal account. 2 assets. The value of the both assets being 70,000 rupees. I transfer that to the machinery disposal account. 31/12/11. I am not aware about which date it is sold, but it can be assumed to be sale happened on the last date. Machinery account 70,000. And don't forget to transfer the accumulated depreciation on that from the provision for depreciation to machinery disposal account on the same date, 31/12/11 and 31/12/11. Machinery disposal account. Machinery disposal account. Here, provision for depreciation account. I need to know the value here. I need to know the value. These two assets was originally purchased on 1st October 2008 and sold on 31st December 2011. So it should be now depreciated up to the date and find out the accumulated depreciation on the assets sold also, one after one. On 1/10/2008, the original value of the asset being, I club these two, 50 plus 7, 20, 70, rather than showing it separately. I can club both because both the assets will be attracted to the same rate of depreciation. The value being 70,000, and for the year 2008 and 9, it is eligible for depreciation for only half year at the rate of 10% on this, because this is WDV method. And since the date of purchase to the year end, only half year is there, so we have to calculate for half year. 3,500 will be the depreciation. Then the ultimate value being 66,500. This is the WDV. WDV as on which date? 31st March 2009. 31st March 2009. 1 year is over. But sold as on this date, right? So 2009 and 10, we have to again claim the depreciation for one full year. 6,650. Okay, 10% on this. Now, after subtracting the value being 59,850, this is WDV as on which date? 31/3/2010. Again, one more year, year 10 and 11, depreciation. For this, 10% will be 5,985. Okay. After subtracting the WDV and on 31/3/2011 being 53,865, and depreciation for the year of sale as on 31st March 2011, 31st December, sorry, 31st December, because it's sold on 31st December. For almost 9 months, we have to now create the depreciation. So 53,865 into 10%, and for 9 months, the value being 4,040. Am I right? 4,040. If I subtract the WDV value as on the date of sale being 53,865 minus 4040, right? 49,825. 49,825. Where both the assets sold for, okay, has to be discarded, replaced by 2 new machines costing, okay, this one of the discarded machine was sold for 20 and then other was 10. I have put the value collectively. So both the assets having the WDV as on that date being, okay, 49,825. 825. Okay, 825. Now, both the assets sold for rupees 30 only. 30. And balance being 19,825. 19,825. This is loss. This is loss. Now, whenever we sell the asset, As on the date of sale, any accumulated depreciation on that will be transferable from the provision for depreciation to machinery disposal account. The original value being 70, and as on the date of sale, the WDV of the asset being 49,825. The difference between these two is the accumulated depreciation of the asset sold, which is 20,175. Am I right? 20,175. That 20,175 should be transferable from the provision for depreciation account to machinery disposal account. Okay, on disposal I get cash to the extent of rupees 30,000, and loss on sale is also there, loss on sale, which is 19,825. 19,825. And on the same time, we purchased new asset also, valued rupees 50 and 25. 75,000 rupees is the new assets value. The date of purchase being 31st December. It is assumed, because purchase happens in December, we assume that the purchase happens the year beginning, the period end. So bank. Both the assets put together purchased for how much? 75,000. 75,000. Is that okay? Whenever we sell the assets, three items to be recorded. One is sale consideration, another one is profit and loss on sale, another one is depreciation for the year, which is 40/40. As we are following the provision for depreciation, depreciation for the year should be transferable to the provision for depreciation account. Here, on 31/12/11, depreciation on the asset being sold, discarded, 40/40, both the assets put together. Both the assets put together. Is that okay? Now, if I tally the machinery account, it will be automatically tallied. Verify this. Because 70,000 is the worth for the assets. As on the date of sale, we have created provision for depreciation to the extent of 20,175. Leaving that amount collected is 30 and balance is named as loss. So, always the machinery account will be getting tallied. Now, we have to find out the depreciation for the remaining assets for the last year. Last date, 31/3/2012 depreciation. This depreciation is for the asset discarded. This is the depreciation to be calculated for the remaining asset. Right. Before I calculate, I will close the machinery account. As we follow the provision model, provision for depreciation model, machinery account will continue to appear at its own original value. 3,75,000. 3,75,000. If I subtract 70,000 rupees, then it is 3,05,000 is the balance carried out. Balance carried out. Now, find out the balance of provision for depreciation. Find out the balance for provision for depreciation. Yes. Yes. This is working note number 1. Number 2. Asset balance, machinery account balance being 3,05,000. And provision for depreciation account balance. How much is that? 1,50,000 for 1,59,040. From there we have to subtract 20,175. 1,54,040 minus 20,175. 1,33,865. From the original value of the asset, if you subtract the accumulated depreciation, the balance is nothing but what? WDV value before the depreciation. WDV value before the depreciation. Once you are aware about the WDV of the assets, you can calculate the depreciation on that. Now, what is the value here? 3,05,000 minus 1,33,865. 1,71,135. In this newly purchased asset being 75,000, balance being existing asset 96,135. Existing asset will be depreciated at 10% usual rate, 9,614. New asset will be depreciated at the rate of 10% since the date of purchase. It's purchased on December end. January, February, March, only 3 months rate of means depreciation will be eligible. So find out that 1875. The overall depreciation for the last year being, yes, 1875 plus 9614, right? 11489. 11489 will be the answer. Okay. Now if you tally, then you will be getting the balance carried on. You will get the balance carried on. Yes. Find out the total of provision for depreciation in the credit side. Make it faster. I think the total being 1,65,000. 1,65,000. 329. 329. 1,65,329. From there, 20,175 is subtracted to find out the balance of 1,45,354. Okay.